time to ditch the excuses. Get up, get out, and shut the f*** up. This is the Adjusting to Six Figures podcast.
All right, and we're here. Anthony, thanks for coming on, man.
Yeah, thanks for having me. I appreciate it.
No problem. So I was eager to get you on because, we had a podcast a couple weeks ago. We had and actually we were just talking about TikTok. We had a gentleman by the name of Rory Douglas on, who's got a massive following on TikTok. And, his message was, his overall message is all about financial literacy and putting your money in the right places. And I'm having that podcast with him. I couldn't help but think, man, I got to get Anthony on here. We got to get you in here. What made you go in the finance direction? I always like asking that question because some people think of finance as something that's so boring. What made you do what you're doing right now?
Well, it's interesting. So my father is a business owner. He had pizzerias, and I think I was 5 or 6 years old, standing on a upside down milk crate, pouring sodas and accepting cash and putting it into the register. And I was always dealing with money, and I just loved it. At the end of the day, Dad, how much money do we make today? We're sitting in his office counting cash, and I think I was just addicted to money at that point. I remember I was sitting in my high school library, I was supposed to be doing something, and I was on E-Trade buying and selling stocks at like 16, 17 years old. And then, I went to college and I said, I got to major in some sort of, finance. And I wish there was like a trading or financial planning or something, but it was just like an overall, financial degree. But I joined the trading club and I did all that stuff. And I had no idea what direction I was going to go. I kind of assumed that I was going to be like an investment banker, New York City, dressed in a suit and, just kind of living the dream, quote unquote dream that you see, Wall Street, that movie, whatever it is. What I quickly learned is that life is very busy. It's very hectic and you can make a lot of money, but the impact that you're making to clients, you don't actually feel it because you're not working with clients directly. You're working, for companies rather than an individual client. So my junior year of college, I was presented with an opportunity to have an internship with Northwestern Mutual. And I learned a little bit about it. My brother had actually been with Northwestern Mutual for about 4 years at that point as a financial advisor. I knew he was doing well. I knew he was helping a lot of clients, making some good money. I didn't really know too much else, about it. Besides that, I quickly learned Northwestern Mutual is the number one internship in banking and finance, a top 10 internship nationwide. So I entered the internship and immediately, like literally within the first week, I was calling my family, my friends, people I was introduced to, and I was sitting at their kitchen table helping them with their financial plan. I was this 21-year-old kid providing impact to people's plans. And, I was successful with it. So I went back to school my senior year. And in October, I made the decision that I was going to become a financial advisor, full time. And that was back in October of 2012. And
oh, wow.
Yeah, it's been, almost 10 years now. Fortunately, I've had a ton of impact on people, helped people save a ton of money, save for retirement, reduce their tax exposure, save for education. I also do a lot of risk management planning, helping people get the right life insurance, disability insurance in place. And unfortunately or fortunately, I've helped a lot of clients go through, 6 clients actually go through claims where they unfortunately passed away and their families had, received some benefit. So, long answer to your question, but 10 years later, I've really seen the impact that this career can make. And, I'm glad I'm here.
This episode of the Adjusting to Six Figures podcast is brought to you by Adjuster University. Independent adjusters are one of the most highest paid people in the insurance claims industry, and very few people know what they are. Adjuster-University.com helps average people learn about independent adjusting and build a high-income business as an independent claims adjuster with its 90-day accelerator program. Adjuster University's 90-day accelerator program takes students through 10 years of experience in only 3 months, getting them licensed and prepared to begin earning immediately after completing the course. To learn more about independent adjusting and what it can do for you, Adjuster University hosts a free 90-minute class every single week. Simply go to adjuster-university.com adjuster.com/get started to register for the next class. Again, that's adjuster-university.com/get started to register for the next class. Don't let a great opportunity like this go to waste and become a part of a growing industry with one of the highest paying roles inside of it. Here's a loaded question for you that I feel like you might have a good answer for, because this is a question I would struggle to answer right now. And if you were to ask me 10 years ago, I would have no idea how to answer this. What exactly is a financial plan? What does that mean?
Ooh, loaded question. Yeah. So a financial plan, I think it depends how in-depth or how basic someone wants to take it, right? So the basics of a financial plan is knowing what money's coming in, what money's going out, right? That's kind of a budget, right? Know what's coming in, what's going out. And then where your money is getting allocated to, the leftover money. Because really you can either spend money, save money, and that's it, right? You're going to spend it or you're going to save it. So when we're saving it, we want to make sure we know where it's going. So for example, it's important to have an emergency fund, 3 to 6 months of expenses. It's important to make sure that, I guess maybe even while doing that, you're paying off your debt, especially consumer debt like credit cards. It's important to make sure that you're saving for the now, right? Saving for your short-term goals and saving for your long-term goals. It's important to make sure that you're protected. Life insurance, disability insurance. And one of the things that everyone loves talking about is how we can reduce tax exposure. Having just an idea of what you're doing in all those areas is a financial plan. As you grow your net worth, right, as you become wealthy, as people become wealthy, financial planning enters a whole different realm of estate planning, right, making sure we're limiting the liability that our family, our estate's going to pay. So there's different realms, but, you know, as someone that is kind of just getting into that six-figure world, living that six-figure lifestyle, it's kind of the first thing I mentioned, right? How do we make sure that you can spend enough money to do the things you want to do while saving enough money for your future lifestyle?
Yeah, absolutely. And when you mentioned risk management, is that specific to getting life insurance and protecting yourself against, you know, when shit happens?
When shit happens is the best way to put it. You know, I've been talking about like the what ifs in life for 10 years, right? And the what ifs are typically, hey, what if you lose your job? What if you become sick and injured? What if you pass away? I never said, what if there's a pandemic, right? But 2 years ago, almost 2 years ago, that kind of became a reality. Many people were getting sick or were scared to get sick. And many, many people lost their job. So I think risk management is doing all that, making sure that if you lost your job for 3 months, 6 months, if you became injured and couldn't work for 3 months, 6 months longer, that your financial plan's okay. It's making sure that if you didn't come home tomorrow, that your girls are okay, right? You got to make sure that the family's okay if you're not there. So that's risk management in its core. And with risk management, you can be kind of strategic in some of the things you're setting up, but the idea is just protecting the risk that is there.
When COVID hit, was there something? I know I didn't have anything aside from, you know, I got the PPP loan, but outside of that, outside of, you know, SBA and government programs, was there something that people smarter than myself could have tapped into, like an insurance policy that could have protected them if they were, say, working in a restaurant, right? Because the restaurants were shut down.
Yeah, there really isn't, at least from what I know, there isn't an insurance policy yet that protects from, you know, a pandemic or something catastrophic that causes you from losing your job. You know, of course, if someone became disabled and couldn't work, then there's certainly policies there. If someone got hurt on the job, there's workers' comp. But when the pandemic started, and at least as I heard of, there isn't anything that protects a business owner or you know, I'm thinking business owners in restaurants. I work with a lot of business owners, but or, you know, just a regular person working in a business or a restaurant that can be protected from that. But like you said, I mean, fortunately, unemployment was given that extra $600 a week. There was the SBA and PPP, so there was a big way to get over it. But unfortunately, what we're seeing now is 2 years later, restaurants are kind of getting squeezed again, right? No more indoor dining in certain places, wearing a mask, etc. And there isn't this stimulus. There aren't the PPP loans. There aren't, you know, extra unemployment. So I think now is when we might, you know, be a little bit a little bit nervous for people, especially in the food industry.
Of course, I think the food industry is an exception, but I think that first wave of COVID was a great opportunity for some people, for a lot of people, to really take inventory of their own vulnerabilities, right? Because I think a majority of the U.S., the majority of the world, really got caught with their pants down, right? Nobody saw something like this ever happening. I mean, a lot of, my scientists have spoken about how vulnerable we are from some sort of outbreak and what effect it could have. But the majority of the population of the world, I think, really didn't give it the credit that it rightfully deserved. And we found ourselves in a position where businesses are shutting down left and right. And now we need these programs, these stimulus, these over-the-top unemployment checks coming in. And so we really found ourselves in an opportunity to adjust our lifestyle to prevent such a liability from such an event affecting our home life as much. And it's unfortunate that there's so many people out there that haven't adapted to that.
Yeah. There's people that haven't changed at all, right? They kind of continued life the same. But as you said, a lot of people have made changes. I mean, just from a financial perspective, I've seen people saving more money, people that are prepared to work from home or prepared to make changes to their business if it gets bad again or if there's something else.
Right.
Like you said, I mean, I remember listening to Bloomberg. I listened to Bloomberg. I watched Bloomberg all day. And, it was February, I think, or maybe even January. And they were talking about coronavirus in China. And it's like, it'll never come here, right? And all of a sudden the cruise ships were in the port and you're like, oh, don't let them out. We don't want COVID to get here, thinking that we're, invincible, right?
Right.
And then quickly it shuts down the world. But what's interesting from a financial perspective, all I was talking about March of 2020, or all I was talking to my clients about was keep your money where it is, right? I had so many clients calling me saying the market's down 30%, drop 30%.
Time to pull out.
Yeah, time to pull out. I need my money. I just lost my job. What do I do? Well, fortunately, I was able to talk all but one client off. One client took 10% of his money. He wanted all of it. And he ended up taking 10%. And ironically, I had a conversation with him a year later about, how big of a mistake that was. And we had a document at that time that showed all of the previous outbreaks. It also included 9/11. It included everything in there that we think the world would adjust to. And what we saw is in the first month, what the market did, in the first 12 months, what the market did, and then what did the market do over time? And what we learned is it's always a buying opportunity.
Right.
Never has the market not gone back up. Even today, as we're recording this, the market is falling, right? The Dow Jones has fallen, the S&P 500, NASDAQ has come down every single day. And my message to my clients is now's a good time to buy.
It's the best time.
It's the best time. The market might go back. It might still fall another 5-10%. But guess what? It's 10% lower than it was 2 weeks ago. So now's a good time to buy. So that's the message that I have. And I think it's important to always have some cash on the sidelines for when there's opportunities like this.
I remember early on, and I don't know why this stuck with me because it's a very unremarkable memory, but I remember someone, like an acquaintance of mine, had put a post on Facebook saying this was maybe a week or so into the shutdown when the market was already on its way to, it was already chopped, I think, down 25% or more. So it's already falling. And this person was telling their network of friends and family that it's time to sell, get rid of everything and protect yourself. And I remember chiming in like, actually, it's the opposite. I mean, you generally want to sell high, buy low, right? That's the general idea of making money. And right now it's going down and you're selling. That's not how it works. You should be buying more because it's going to go back up. And of course I was told that that's crazy. That's not how it works. And it remarkably recovered way faster than I thought it even would. Sure. You know, I threw a couple more bucks into the market as it was crashing down. And then I felt like next thing I knew, I could have put more in. Now we're cutting right back to square one.
Yeah, I mean, who would have thought we'd see over 20% gains in both 2020 and 2021, you know, while COVID has started and persisted throughout. So that's the right mindset. And it's important to also make sure that there's specific tools in place that if you need your money, you don't actually have to worry really what the market's doing. For example, one of my clients just opened up basically a line of credit on their investment account where they get to borrow from their investment account without actually having to sell their assets.
How does that work?
Yeah, so basically these third-party lenders will understand how the markets work. What they'll do is they'll lend you 50% of your account balance. You pay them a small interest rate. It's about 3.75%. And you get to access your money without actually selling. Why is that important?
At 3% and change.
At 3% and change. So what's so interesting, one of my clients reached out to me a couple of weeks ago. He said, look, I need some money. I'm doing some repair to my house. Took a look. I said, listen, the market's been doing well. Who knows what the market's going to do? Why don't we open up a line of credit? He was like, kind of same reaction. What are you talking about? So I explained it to him. He said, great. He hasn't accessed the money yet, but wouldn't you know, the market's come down about 10%. So if he were to sell, he'd be selling at a short-term loss, right? But now he's going to be able to borrow his money, pay a short interest or a small interest rate. He only needs it for a few months. So 3.75% over a few months is probably less than 1%. And he'll be able to pay it back, and he won't have to sell any or liquidate any of his accounts. Therefore, he won't have to pay any tax on his accounts. It's really a fantastic strategy to use should someone need money.
That is a very interesting concept that I was not aware of. Yeah. So you could essentially, I don't know if this is a good idea, but you could essentially, if you have, say, $100,000, you've got $100,000 in an investment account, okay, and you feel the market correction is around the corner, you could take 50 out at a rate that's basically the same, if not a bit less than a mortgage, than what the mortgage rates are. Take 50 out, watch the market collapse, and then when it feels like you're close to the bottom, throw that 50 in there and then wait for it to come back up.
You know, I wish you could. So technically, when you're setting these up, they ask you what your purpose of the money is. The purpose cannot be to buy additional securities.
You can't gamble with it. Okay.
I think they figured that out, because if you gamble with it and then lose it, that's not a good thing.
Right.
But the idea, the concept of it, of having money on the sidelines to buy when the market's down is great.
Yeah, and that's especially, I've got to look into that, because my goal this year, I've spoken about this on other episodes. My 2022 goal is, I've been bullshitting around about this for a while now, and I'm to the point where, I had an interesting year. 2021 was a bit interesting. I had, all throughout the year, I've had this thing in my head. I want to get into real estate. I want to start putting some money into real estate. I've learned enough. I've learned all I need to learn. I have confidence that that's how I'm going to build a lot of wealth, is through real estate.
Yep.
But I don't have the money for a down payment. I've got all these other bills, everything like that. And once I get everything figured out, that's when I'm going to start putting money into real estate, and we're going to go. But through 2021, I had a few things happen to me that required a big chunk of change to come out of my pocket. Not into real estate, just into other things. I had something where I needed to really quickly put together $30,000. I had a very short time frame. I put together the $30,000. I got it taken care of. I had something else come up where I needed $40,000. Put forward in an even shorter time frame. I put the $40,000 together. I put everything together. I had $40,000. I put it in there. So when bullshit arises, I can all of a sudden find money. I can make things happen. But when it comes to building wealth, I'll get to it, once I pay some bills first. Yep. So understanding that about me, 2022, I decided like that's fucking, I'm not playing games with myself. I want a income producing property in the first half of the year. I want an income producing property in the second half of the year. And I'm going to, do what I got to do. And my initial plan is, well, I'm going to do a little cash out, look into doing a cash out refinance on my house. Cause I got a good deal on my house. When I bought my house, I got it for less than asking. Then I got it appraised for more. And this was right as the real estate market was starting to take off. And the house across the street from mine just also appraised for $100,000, appraised a short while ago, or sold a short while ago for $100,000 more than what my house was appraised for when I bought it 2 years ago.
Wow.
So I'm thinking, well, this is an opportunity here to take that out. But even that, maybe you pull out 150, something like that, $150,000. Now I have something to play with. That's not an awful lot. You're putting 20% down. You can start looking at a, $600,000 property, something like that. But that strategy of possibly looking into an investment account and then pulling that money out while keeping the investment there, gaining value and still having money on top of it. I mean, that's more ammo. That's brilliant.
More ammo. It's the same concept as a home equity loan, right? You're taking equity out of the home that you currently have. Same way of taking equity out of the investment that you currently have. By the way, we have the exact same strategy with cash value that's inside of a life insurance policy. Personally, for me, I have the line of credit open on my life insurance. I have the line of credit open on my investment. I don't have a line of credit open on my home yet, but I know that I have the ability to do it. I've never used any of the money from the line of credit, but I have the ability to do so. How
does that work with the life insurance policy? Because I want to talk to you about that too, because the life insurance thing, it's a topic that I have spoken about so much to so many people because I believe in it. And I don't think I believe in something so much that I know very limited about. I know some things, but I would love to pick your brain a bit on how important it really is for anybody to have a life insurance policy, because the overall, and I'd spoken about this before, the overall feeling, and the guy Rory Douglas made it a great point, and I want to bring it up now. When you buy a home, you buy home insurance, right? You buy home insurance for things that happen to a home. Yeah. When you buy an automobile, you buy auto insurance in case something happens to your auto. You buy and then when you ask, what do you buy life insurance for? People automatically say for when you die. It's the opposite. So you buy auto for auto, home for home, life for life. And that's what it should be. And most people just think that that's a life insurance policy is just when you die. So I try my best to explain to people that that's not exactly what it is for. But I'd love to hear what you have to say about that.
Yeah. So, and first off, I just want to go back to what you were saying. Kudos to you for purchasing, having it set that you're going to buy an investment property first half and second half of the year. I love it. Real estate should be a part of the portfolio. You should have money in different places. So that's going to be a great place for you to have money. And I look forward to having some conversations with you about that and, where to take money out from and so on and so forth. So great work there. Life insurance. So I will definitely get into that. What you said, though, reminds me of something I've been talking to my clients about since day one. I actually have a piece of paper, and it literally says, like you just said, home, auto, personal items, etc. And you go through and like, hey, like you said, do you have car insurance? Yeah. Do you have homeowners insurance? Yeah. Do you have insurance for your cell phone? Yeah, I do. Right. Do you have insurance for whatever? Yeah. Then I always get to this one, income. Do you have insurance for your income? People are like, oh, well, what do you mean? Oh, well, like, if you couldn't go to work tomorrow, or if you didn't come home and your family was relying on your income, do you have insurance for it? No. And when we look, let's just take someone that's making $100,000 and let's just say they're 30 years old and they have 35 years ahead of them. With no inflation at all, that $100,000 for 35 years is $3.5 million. And oftentimes people don't pay anything to insure it, yet someone will pay $15 a month to insure the $1,000 cell phone. They'll pay $200 a month to insure the couple $100,000 house. They'll pay $150 a month to insure the $30,000 car, but they're paying nothing to insure a $3.5 million income. So income protection through the use of disability income protection is vital. If you can't go to work tomorrow, making sure that your income continues to come in.
Right.
And then, as you said, life insurance is for your life. So ultimately, there's two benefits to a life insurance policy. There's the death benefit and there's the accumulated value. The death benefit is what your family gets when you're no longer here. Why are they getting that money? Why do they need that money? There's 4 reasons, and the acronym for it is LIFE. It's your liabilities, so that's your debt. I is your income, replacement of your income. F is your final expenses, and E is education. So life. You need life insurance or liabilities, income, final expenses, and education. So we want to make sure you have the right amount of life insurance. But from there, when we have designed the right policy, you then have what's called the accumulated cash value.
Right. That's the big one.
That's the big one, right? The accumulated cash value, there's different ways you can structure a policy. You can have it be in the stock market where there's stock market risk, or you can have it be outside of the stock market. Many of my clients prefer their policies to be out of the market. Everything else in their life is risky, right? Your occupation, your real estate, your investment account, your retirement accounts, that's all risky. That's all in the stock market. And they're looking for something that's safe. Now, typically, when we think of safe money, we think of a bank account. A bank account is unfortunately is low yielding and highly taxed. What do I mean by that? It's earning nothing, 50 basis points, 0.5%. And any of those earnings are actually getting taxed at your highest tax bracket. So what we look at is, can we get a safe rate of return inside of a life insurance policy that's actually growing tax efficiently where you can access your money tax free? So when designed with the right company, so for example, I'm with Northwestern Mutual. Northwestern Mutual is a 165-year-old company at this point, established in 1857, over a $300 billion company. In 2022, we're going to pay $6.5 billion to our clients in dividends. Well, the way dividend works is it comes out to you as a dividend interest rate as a policyholder. So you're receiving a 5% dividend interest rate. So think about it. Your bank account's paying you 0.5%, and Northwestern Mutual is paying you a 5% dividend interest rate on the accumulated value in your policy. And the money in your policy is actually guaranteed to grow because, remember, there's no market risk. The money can never move backwards. This is typically not a short-term account, right? It's somewhere where it's something you're going to hold for the rest of your life because, again, it is life insurance. Hopefully everyone lives a nice, long, healthy life and will need the money long-term. And the cash value, the accumulated value is going to work the same way, where you're not going to access it for the next. Usually I recommend clients to pretend it's not even there for the first 15 years. And then it's going to be there for you long-term, right? It's going to be there for you tax efficiently. You have access to it tax-free. It's going to be there outside of the stock market.
You mentioned it doesn't move backwards. What did you mean by that?
So contractually, in a life insurance policy, in a whole life insurance policy, the accumulated value can never lose value. It can never go backwards. Whereas if you had a retirement account, on January 1st, as of today, January 21st, and it's being recorded, your retirement account's probably 10 or 15% less than it was, just because of what we see in the market. Where the life insurance policy that someone has is the exact same it was as of January 1st, actually it'd be higher because there's no market risk. It contractually can never go backwards. I mentioned before, right, the line of credit. So life insurance, or I should say an investment, they can lend you 50% of your account value. With a life insurance policy, because it can never go backwards, because there's no risk, and because the banks know if you were to pass away that they'll actually get their money back in a death benefit, they'll lend you 95% of your cash value.
Wow.
So the idea, it's prime plus 25 basis points typically. So that puts you around 3.9% right now. So the thought is you can borrow money at 3.9% while it's actually growing at 5%. It's a little bit of an arbitrage there, right?
Right.
So it's a very interesting way to utilize your money. So personally, my wife and I are planning on buying another house in the next 6 months, a year, something like that. I'm going to use money from my life insurance policy, not directly from it, but from the bank that's offering me a line of credit on it.
So you have your life insurance policy, and let's say you're renting, right? You're renting, you want to get into your own house, but like so many people, you don't have a down payment. Yep. But you have this life insurance and you could take, what you're saying is that you could take money out. It's possible for you to take money out of the policy and put it on there. But are you saying that you could do that, or you can take out a line of credit up to 95% of the accumulated value, take that money, which you'll get charged 3% and something.
Yep.
Fine. You're going to take that out. You'll use that money as your down payment. So now you're getting in the house and you're getting all the benefits there and the equity and all that sort of stuff. Now you're going to get charged the 3% and change, but you still have the value. The value of your policy has not changed. And that value you're getting 5% on still. So you're essentially, in a way, you're earning a point on top of getting that 3% paid for. That's blowing my mind right now.
Yeah, there really is a level of arbitrage in there, right? Where you can borrow for less than you're earning, right? So 5% dividend interest rate, borrowing at 3.9. Now, either one could change. The interest rate could increase, right? If prime increases, the government says prime increases, then your interest rate on your borrowed money will increase. If Northwestern Mutual says the dividend is going to decrease, which very rarely, if not ever, really happens, 5% is one of the lower spots where Northwestern's been. But anything's possible. So it's not one of these, set it and forget it kind of things. It's something we'd always want to monitor if you have money that's being lent out. But as of now, there is that little bit of arbitrage. Now, I think it's important to not be paying any debt, right? I prefer not to have any debt, except for, a mortgage or something like that. So for me, like what I would do is I would view that as part of my 20% down, and I would try to get that paid off pretty quickly so I can have my line of credit sitting there fully accessible.
Right.
But for me, like perfect example, I bought a first time home back in 2018. We put 5% down. But now you go to buy a second home, you have to put 20% down. Right. So if that next home is $800,000, you're at 160 plus closing costs, et cetera. You're now, $200,000 all settled by the time you move in. Man, where do you get $200,000 from? Most people don't have that sitting in their savings account. Right. So now you start saying, all right, where can I access the money from? Where can I pull it all together?
Right.
That's the strategy there.
And you can't have that without life insurance. That's a part of the vehicle of life insurance.
Part of the financial plan is life insurance for sure.
Let me ask you, when COVID hit, or I guess the better way to frame this is after COVID started to rebound, we were rebounding from COVID. Did you get a pop of new business coming in?
Yeah. So we track how many policies are sold like individually. Most years I would sell around 150 policies. In 2020 started out like a normal year, January, February were normal. Mm-hmm. But throughout the whole year, I actually sold 234 policies.
Wow.
So yeah, it really took off. Last year was in 2021, it was like 195 policies or something. Still high. Northwestern Mutual, again, we've been around 165 years. We are the largest life insurance company, one of the largest investment companies. We actually broke our record by the end of the third quarter. So with an entire quarter left, we had already beaten our previous year's sales. Why is that? One is there's a heightened sense of, man, I might pass away. But right. Two is people are just learning a little bit more about these tools. I think as a financial advisor or financial advisors are maybe becoming more educated in the tools and are able to help their clients out better as well. Efficiency, by the way, that's a whole other idea. Working from home, we're all efficient, right? We can help clients, but help them quicker. But yeah, there's totally been a push towards it. The other thing is with the government lending out trillions of dollars last year, right? Not collecting student loan payments, still not collecting student loan payments, stimulus, PPP, et cetera. There's only one way that the economy, the government's going to try to claw back any of that money, and that's going to be by increasing taxes, right? So as clients learn that your money can accumulate tax-free inside of a life insurance policy with limited restrictions, right? There are restrictions in a Roth IRA, et cetera, but you can have certainly less restrictions in a life insurance policy. I think there's even more, desire to purchase those and have those as part of your plan, kind of forecasting that taxes will be higher in the future.
Right. And I think it's one thing that I've noticed is, in my opinion, I think that social media and podcasts just like this, this is really what is catapulting our general population to be more aware of vehicles like this, to be more aware of life insurance and what it actually means. I mean, right before we jumped on the podcast, we briefly mentioned TikTok and that it was kind of going to start growing my TikTok account, but I've been messing around there and I flip around a lot and I watch a lot of videos that are, on the financial planning and literacy and things like that and taxes. And it's through watching these little 30 to 60 second videos that I'm catching these little tiny things that nobody told me, I didn't know about. I try to be as smart as I possibly can with my taxes, and they say, you should always get a good CPA, as if the CPA is going to always know what's in your best interest without really knowing you on that level. It was through these little videos that I start catching on things like the bonus depreciation on 6,000-pound vehicles. I had no idea what that was. If I'm not mistaken, this was a program that was started under the Bush administration. Back when President Bush was trying to get more auto sales, because he was in deep with Exxon or something like that. He was in deep with Exxon, and Exxon said, we got to get more SUVs out on the road. And he said, okay, well, this is what we're going to do. We'll make it so that you can depreciate the full cost of a heavy vehicle. And I believe it's 6,000 pounds. So you could depreciate the full cost up front. You don't have to do it over a course of so many years. And if I'm not mistaken, that program ends. This is the last year that act, I believe it's an act, will be in effect. And I thankfully caught it just in time, baby, because Papa's getting a Range Rover this year.
There you go.
I'm not getting a Range Rover, but it's these little tiny things. And if it were not for something as silly as, what was known as the new fad for kids, TikTok, I probably wouldn't have even known about it. And that's just one small piece of the puzzle. And, podcasts like this, and it's just getting people more aware of where they are financially. And I'll tell you what, I also want to throw a disclaimer out there. If you're listening to this podcast and you haven't caught on at this point, I work with Anthony. I'm a client of Anthony. And so I'll say that to say this. When we first started working together, I filled out an application one time and I had to fill out all my assets and all my liabilities. And I rose my eyebrow a little bit when I was doing that. But when I signed up and I was a customer of Northwestern, they had the online dashboard. Right. And I'm not sure how familiar you are with it, but they got the online dashboard and you link all the accounts just like a QuickBooks you would, right, if you're doing your budgeting. And I was able to put in there all of my assets and it calculates for me what my net worth is. People think of net worth. They think of Jeff Bezos, Elon Musk, people with, billions and billions of dollars in their net worth. I don't think most blue collar people, if not nearly all blue collar workers, people that are making $50,000 a year, $75,000 a year, $30,000 a year, don't think about their net worth, because what is that really? What number is that? It's probably just going to make you cry, right? But once I saw it, and by no means was my net worth, when I got done calculating everything, by no means was my net worth anything to brag about. I mean, I had debt. I had a couple good things going for me, but I had some bad things going for me too. But when I saw that, I was like, shit, that's my number. And I think it was equally higher than I thought it would be, but it also caused me to reflect on how low it was. And I think that anyone that wants to improve their finances, if you don't know what your net worth is, to me, I feel like that's step one. That's what your base is, because from there, that's where you need to move up. You don't want to move backwards. You need to move up from there. I'd recommend anybody listening to this do that. Do you have any thoughts on that?
Yeah, I mean, I think there's a lot of education around net worth. Personally, I track my net worth every month. It takes a second, take a look at it. What was it last month? What was it this time last year? And like you said, when you're in kind of the thick of it, it doesn't maybe feel like you've saved much money. But when you look a year later and maybe the equity of your home has gone up and the value of your mortgage or what you owe on your mortgage has gone down, and the same for all your accounts, you see that your net worth has actually increased. One of the things I have found to be most helpful with net worth is when people have some credit card debt. Everyone's always a little anxious. I don't really want to move, say there's $10,000 of credit card debt. I don't want to take $10,000 from my savings and use it to pay off the credit card debt. It doesn't feel good to do that. But when we look, someone's net worth doesn't change. Right? If someone had $20,000 in the bank and $10,000 in credit cards, their net worth is $10,000, right? 20 minus 10. If you then took 10, paid off the credit cards, your net worth is still $10,000, but now you're not paying any interest to the credit card company. Now your credit's going to improve every month. One way to think about it would be you just took your $10,000 out of your savings account that you're getting 0.5 or 1% if you've got a good bank, and you just put it in an account that's going to yield you 21, 24% by getting rid of what the other bank's taking you for. Yeah, that's 100% right. I mean, banks, people are so uneducated. Oh, yeah, I have a credit card. I pay the minimum. And you look and they're charging you 20% a month. Imagine it, or I'm sorry, 20% a year. Imagine you have $10,000 of debt. That 20% a year is $2,000, right? So That's a lot. So I think, taking a look at net worth is a good way to do it for sure. And I think right now I haven't checked. You check yours every month, man. I gotta catch up to you because I haven't double checked on mine in a while. But I know the two things that I count on, that despite all of my cash coming in and credit debt and all my bills, the two things that I know that are going to be a big driving force for me is going to be my mortgage. It's going to be the appreciating value of my home and the reduction in the value of the mortgage, right? So I'm building equity there. So I'm just paying my mortgage. I'm just doing what I do. I got to pay that or else they'll take the house away. But every time I pay that, I'm paying a shitload of interest. That doesn't mean anything to me, but every month a little bit more chips away at that value. So I get to keep that. That's basically mine. It's just not cash. It's just equity, which a lot of people don't get. And the other part is the life insurance policy. I got to double check on that big time, man. I haven't even looked. You said 15. What did you say before? 15 years, don't look at it? Yeah, I mean, we look at it every year, right? Together in our client reviews, but really just pretend it's not even there for at least 10, 15 years. Let it really start growing for you. Yeah. Let me ask you. Yeah. We don't need to go into specifics. I know I brought this up, but so I think that we started working together about 2 years ago. And I've been dumping money into that life insurance. Would you reckon, I think for maybe 2 years, year and a half or something like that, would you say I might be in a position to consider if I needed to pull money out of there to look at it? Or is it, we need to let that mature a little bit longer? Let it mature a little bit longer for two reasons. One, you really want the cash value just to continue to compound on itself and continue to build. Two, as we were talking about before, being able to borrow from it through a bank. Many banks have lending minimums, for example, 50 or 60,000, believe it or not. So a lot of clients, if they're putting in $500, $1,000, whatever it might be into a policy per month, it's going to take some time for you to really accumulate a good amount of money that the bank's willing to look at it. So pretend it's not there, I would say. What's the least amount? Is there for yourself for financial planning? Okay. And I feel like this is something that held me back for a while. We started work. You were my first financial planner, like official financial planner. And we've been together for a year and a half, 2 years, whatever it is. For a good moment in time prior to that, I did not have a financial planner, in part because I felt like I was not at the level. I was not at the income level where I would need one. I thought that financial planners, that's something where once you've got, thousands, tens, hundreds of thousands of dollars in the bank, that's when you need to get a financial planner involved to make sure everything's right. And it really wasn't until I had a friend of mine at the time who had no freaking money. This dude was broke as a joke, and he had a financial planner and who helped him out with his money. And I always thought to myself, how the hell is this dude getting paid? This doesn't make any sense to me. Is there a age or not an age, but is there a income level that
you should be at to start thinking about getting a financial planner? Is there a minimum?
No, there really isn't. I mean, when I started, again, I started in college. I was a junior. Someone told me, hey, you should, if someone qualifies for the fog a mirror test, then you should meet with them. How does someone fog a mirror? They breathe if someone's alive. So I was like, all right, cool. I was calling my classmates, et cetera, that were maybe making some money doing internships or just graduated college. And I was helping these clients out save $50 a month, maybe even less, save $25 a month. We were talking about building an emergency fund, paying down debt. And here we are 10 years later. Some of these clients have really blossomed. They're making a lot of money. They have a lot of money. One of my clients recently called me and said, hey, I made a deal. I made $400,000 on this deal. I need to invest. I'm like, where'd that come from, right? So sometimes you just have to start early and then grow. What I would tell you is, again, there's probably no minimum for when you should start. Financial planning might be a little frustrating if you're not making enough money to afford your own lifestyle, because then the conversation is going to be pulling back your expenses, paying off your debt, kind of, can you earn more money? That's going to be a little frustrating. There's probably not going to be a ton of value that I can add from an investment, insurance, strategic tax management perspective. But once you're earning above and beyond what your lifestyle costs, once you have some disposable money, you should certainly be working with an advisor. In parts of America, it's different, right? Here in the tri-state, if you're making, a married couple with a house and children of $200,000, there's a little bit of money. Probably there's not as much as you might think. If you're in the Midwest, you're making $200,000, you probably have a lot more. One of the things that I tell clients all the time is it's very easy to do some maybe Roth IRA investing, what have you, if you're under the income limit. The IRS says if you make more than $204,000 and you're married, you can't do a Roth IRA. Well, working with an advisor, there's some strategic things we do, known as a backdoor Roth IRA, that can actually help you do that. Long story short, at any point in time, you should be working with an advisor. If you're making over $200,000, you should definitely work with an advisor.
Right. Let me ask you, if you're 25 years old and you've got about, let's say, $500 above and beyond your expenses at the end of the month, you got $500.
Yep.
Is it worth at that point getting a financial planner? And I'll follow that question up with, would you focus on life insurance? Would you focus on establishing a retirement account, or splitting them at 250, or some sort of hybrid of that?
Correct. Yeah, it'd be a multifaceted approach, if that's the right terminology. Two-pronged approach, three-pronged approach, probably be investing for the short term, investing for the long term, utilizing life insurance, utilizing some sort of IRA, probably at that income limit or income level, Roth IRA. We'd have a focus around maintaining an emergency fund and being debt-free. So I don't believe in a single approach, a siloed approach for anyone. I believe we should be putting money into different places, really spreading out your net worth. As I told you earlier, my brother got me into the business, right? He started with Northwestern Mutual first. I was 18, 19 years old. I went to his office. I met with one of his peers at the time, and I had $2,000. I'm like, I want to get this $2,000 invested. So I invested it, and it sat there for years, and it started growing. And then once I started working, I started adding to that. And years later, I mean, that's a sizable chunk of change. And I was 18, 19 years old.
Fantastic. All right. Well, let me ask you this. What's next on the horizon for you?
Just continuing to grow, continuing to meet clients. I'm in this business, for my clients. I'm not going to enter into any other role besides working as a financial advisor. So I'll be building my team, right? The more people I have on my team, the more clients we can help, the more services we can offer, but continuing to help my clients and bring on new clients. I'm in the client building business, where I'll take on an extra 60 to 100 clients, probably somewhere in the middle, 80 clients this year. Taking on 5, 6, 7 clients a month. I have, high capacity. I'll keep, 70 or 80 meetings with clients per month. It's busy, but I have
that's rough.
I have a really good team behind me. I have one woman, her name's Maria. She works with me full time. And then I have 7 associates that are on a team, and they do all of our financial planning, account opening, et cetera. So it's really fun, working with the team and helping out our clients. And you know what? One of the nice things about working with clients is I try to have a friendly relationship. right? Like you and I feel like there's a friendship here, and I do things like this. I Facebook friend all my clients, so my meetings aren't necessarily spent on, hey, what's new in life, because I've been tracking them on Facebook and keeping up with their life. So we can kind of get to the nitty gritty of financials.
Yeah, absolutely.
Yeah.
Well, how can, if somebody's out there right now and they're listening and they're like, all right, they need to make a move and start planning on that, which if that's what you're thinking the right way. If you've been listening to this podcast, the Adjusting to Six Figures podcast, if you've been listening long enough, I hope that you've got a little bit extra at the end of your month, and it's time to put that money to work and get in some vehicles that are going to protect you, protect your family, and start building that real wealth, because you're not going to build wealth by stashing your money in the savings account. It's not going to happen. And you need these vehicles to help you get to where you need to be. How can anybody find you, and how can anybody get hooked up with you?
Well, there's a couple different ways. One, my phone is always available. My office line, if you have a pen and paper, 609-750-7766.
Blow him up.
Blow it up.
It's surprising to me to hear, how many clients do you have?
It's funny. Someone asked me that the other day. I don't know the exact number, but I would tell you, not all clients take me up on, annual financial plan, or even depending on what the client is. Sometimes I'll meet with my clients quarterly. So I have a lot of clients, but sometimes people don't take their financial plan as seriously as they should. They'll become a client. We'll call them in a year, call them in 2 years, and they're like, nah, I'm good. I don't need to meet. So it's not as people tend to think, well, if you have so many clients, aren't you always meeting with them? I would love to say yes, but again, a lot of clients just don't want to meet. Maybe they're embarrassed. Their plan hasn't changed, or, whatever the case might be. The golden number, though, in my world, we say you should have about 1,000 active clients. So what that is there's about 250 days a year that you're going to work. You can meet with 4 clients a day and spend your time with those 4 clients.
That sounds reasonable.
Yeah, look, certain clients are going to want to meet quarterly. Certain clients are going to want to meet semi-annually. Other clients, as I said, are probably going to meet every other year. So I think 4 or 5 meetings a day with active clients is kind of the goal. That's
shocking, because I've never had an issue. I've assumed that you didn't have that many clients, just because it's anytime the handful of times I've shot you an email, I mean, you just get back that day. I don't have clients like you have clients. And sometimes it takes, I think you emailed me yesterday morning. It took me a full 24 hours just to get to your email and to talk about the podcast. And I was like, shit, I hope he didn't think I was ghosting him.
That's right.
So you're way more attentive than I am. So you're a hustler. I mean, that's number one. You get it done, man. And you've got a great team behind you, and I wish you the very best. And I hope at least one freaking person listening to this right now gets hooked up with you, and you can help them change their future.
I appreciate that. And by the way, for anyone else, certainly always feel free to call me, but you can also simply Google Anthony Meglio, Dimeglio, Northwestern Mutual. It'll take you directly to my website. On my website, you can actually look at all the services. You can look at my team, and you can even schedule an appointment with me directly through my website.
Go and check out the notes. We're going to have notes with the podcast. Check that out. We're going to load it up with all the links and whatnot. Anthony, great having you on, man. And we got to talk about my policies.
Sounds good.
All right, brother. On to the next one, man. I'll see you then.
All righty. Be well.